Hey, it's Savannah. I wanted to jump on here really quick and talk about some fintech companies. So what is that? It's financial tech. And specifically, I wanted to talk about the real estate ones. There's OfferPad, Open Door, those kind of things that you hear about. We know about the Zillow catastrophe that happened last year. If you don't, ask me for the link and I will send you the Zillow link about everything that happened with that and how they lost $500 million. But essentially, these companies, these real estate financial technical companies have been buying houses and trying to resell them on the market, right? They've offered, oh, it's so easy to sell with me. It's so easy to buy with me. You don't have to do anything. Don't worry about a realtor. Let's just buy your house for you and we'll deal with everything else. And people have bought into that because of the ease of it, because their marketing's really good. First thing I want to say is that those companies do usually charge a commission. So even if they say don't involve a realtor, like save the money, you're actually losing a lot of money. And I tell people this in my listing consultations when I'm talking to sellers, when I'm talking to buyers, I'm like, hey, watch out for these people, because one, if these companies are gonna buy your house and make a profit on it, can we do that? Could we slap some lipstick on a pig and make some profit? That's one conversation to have. The second conversation is that typically they do actually charge a commission, and a lot of times it's more than I charge. It's more than a lot of people charge. Just there's no price fixing in commissions with real estate, but Open Door, I think it was Open Door, just did a discount program. They usually charge 7.5% to buy your house. They're charging you to buy your house. And right now they're down to 5% because it's a discount. And why it's discounted is because they're bleeding money, which is what I wanted to talk about today. So I have a few numbers here on my notepad. Again, I am not a CPA. I'm not an economist. I'm not an attorney. I'm not any of these things. This is just stuff that I'm listening to because this is the market that I'm in. So I wanted to tell you guys because it's craziness. First things first, these are publicly traded companies. Their stock has been really down, and what does that really mean? So OfferPad, they've been around the dollar mark for a while, and if you get below a certain threshold on the public trading stocks, you're on the critical delisting after 30 days if you are not increasing, if you haven't gotten past that critical point. They're right there. They've been hovering there for a while. So a lot of people are selling their stock. They're trying to get rid of it. And the company is trying to do anything they can to prove to their stockholders that it's actually a viable company still. So in order to show that path to profit, which is what they want to show, they have been doing a bunch of layoffs to make it seem like they're profiting, right? That their profit margins are better. Well, of course your profit margins are better if you're not paying as many people, right? But then how is your product going to sustain itself? I don't know. So let's look at the numbers. Okay, Open Door in the first quarter of this year. So the second quarter literally it ended yesterday, June 30th. Today's July 1st. In the first quarter, Open Door bought 9,020 homes across the US. Guess how many they sold? 12,669. Do you see the discrepancy? Because it's about a 40% discrepancy. And they didn't buy enough to backfill their inventory. And that'd be fine if it was maybe the fourth quarter where real estate's a little slower, but it's the third quarter, and that is the fastest quarter for real estate sales and real estate buying, which means they did not get enough backfill to sustain them through the busiest quarter of the year by 40%. So that's crazy. They made 28 million in profit, which sounds really good, but the cost to replenish what they did sell would be 1.26 billion if you look at the average price point that they buy at. So 28 million profit. That sounds really good when they show the headlines, when they tell their stockholders that, but there's a giant deficit that they need in order to sustain itself. So I just wanted to talk about that, and I wanted to talk about why that is. One of the main reasons is because it was really cheap to borrow money for the last 2 years. So they were borrowing money, doing all this stuff. But right now, it's really expensive to borrow money, right? It's about the 6%. So when you're buying at such a large scale and you're not making as much of a profit margin, you have to lay people off. You have to pretend that you're okay. They're all bleeding money, guys. This is the same thing that happened to Zillow that I talked about last year. All of us realtors were like, how are they doing this? They're just bleeding money. Like, how can they sustain this? Well, they didn't. And Zillow laid off a third of their workforce and lost $500 million, and they had all this craziness happen. So what do we think is going to happen to these other big iBuying? They're called iBuyers because they buy electronically. They don't, most of the time they don't even see your house, or they FaceTime you through the house. It's crazy. So this matters. Market share does not equal profit, and profit matters. So even though you see these people all over the place, they pay for the big ads, they're not making a profit. So what's going to happen? Well, when their stock goes down, and listen to this too, this is a side note. The top 3,000 companies in America, there was a study on, where was it, Bloomberg, that we were reading, and out of those 3,000, 620 of those companies did not make enough money to pay for the interest on their loans throughout the past 2 quarters. That should be terrifying to you. That's why the stock market's kind of doing what it's doing. There's other factors, but that's what I look at, because guess what that means for me and what it means for you homeowners and you buyers, is that when people take money out of stocks, they put money into real estate. It's typically what happens. So right now, 67% of buyers are owner occupants, which means normal people buying their stuff. 6% are those big hedge funds, but the other, 23% is normal investors that are like, if I were to buy, a second home, or if I were to buy an investment property down the road from me, or if I were to buy a property for my mom, that's technically an investor. It's a second home. So anything under 10 homes, that's a good chunk of the market, but 67% is still owner occupant. So that 6% of hedge funds and people that are, taking money out of the stock market and going into real estate, it might get bigger. But it's been craziness. So I just wanted to update you guys on the iBuyers, what they're doing, how they're doing it, how they're not doing very well. So don't invest in them. If you're thinking about selling with one of them, talk to me first, because again, I'm a no pressure person. So if we just want to talk through, hey, Open Door's giving me this, what can we actually do on the market? We can actually run numbers and go through what would be best for you. And I've done that with people. There's sometimes where the house is in such disrepair that sometimes Open Door takes it without seeing it. I'm like, hey, it's a good deal because the sheep's or the wool's over their eyes or whatever. You know what I mean? The Open Door doesn't know what they don't know, and that's their problem. That's their business model. But right now they are really, really struggling. So just be careful what you read and the headlines that they say, we did this much profit. Look at the net, because profit doesn't make any sense. Well, you can't just look at profit, you have to look at loss. You have to look at actually what did they take home? What did they actually make as a company? Because you can bring in all the money, just like Amazon did for like 20 years. They brought in so much money, but they were bleeding so much money that they were in the negative and negative and negative until I think, a few years ago, like 5 years ago, something crazy like that. So just be careful what you read, look at the numbers, and if you need any information, talk to me and let's strategize.